Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra with me, Bhatnagar, and this is Market Today. It's Tariff Thursday, and we're going to be discussing a whole lot of what was announced by President Donald Trump overnight in this particular show. And to help you understand will be a flurry of top market experts all across the world that will be joining in on this special broadcast over the next 1.5 hours. Let's start off with the big headlines. Donald Trump marks Liberation Day with bold economic move. Reciprocal tariffs coming. In this major speech, President Donald Trump promises to impose reciprocatory tariffs on foreign goods, signaling a significant shift in U.S. trade policy. The announcement comes as U.S. seeks to counteract unfair trade practices from foreign nations. New tariff strategy announced 10% baseline tariffs on imports to take effect from April 5. And also apart from this, there will be a flurry of tariff hikes in addition to 60 other countries with which Trump and the US trades. Trade war intensifies as Donald Trump has imposed 34% tariff on China and 26% on India. China already has talked about retaliatory measures. They say resolute countermeasures will be taken place. Financial markets react negatively to the latest developments in the U.S. trade policy. We've seen the Dow futures plunging over 1,100 points. We've also seen the Asian markets starting off the day with sharp cuts. Nikkei down at 8-month lows and GIFT Nifty now indicating a negative and a gap down start. The world was on the edge when we talk about Donald Trump's tariff announcements, and they are now a reality. We already have seen 3 key announcements from President Donald Trump: a 10% baseline tariff across the world, and additional tariffs on 60 other countries, varying anywhere between 20 to 45%. What we've also seen is that India has been given a tariff rate of 26%, although Donald Trump has said that he's been kind and lenient by these discounted rates that he has announced. Good morning, Shail.
Well, Sakshi, I really wonder whether this is going to be a good morning at all or not. Just look at the Nikkei. It's down almost 1,000 points, and that's because the tariffs on Japan, Vietnam, China, large parts of Asia are now beginning to be felt on equity markets. So let's hope what is going to be a very volatile day is likely to be really painful. Look at how the US futures are reacting. Remember, these announcements came after Wall Street shut. So there was a mild green tick, but US futures are down dramatically. We have the Dow futures down 2%, SPX futures down 3%, NASDAQ futures down 3.4%. Russell 2000, which is the small cap index for them, is down 4.2% in futures. And that's because 43% of US 500 companies that make up of the SPX 500 have 43% of their revenue coming in from overseas. So if America makes life difficult for companies which export to America, then American companies will face similar problems when they export to countries such as China, countries such as Vietnam, countries such as Taiwan. Now, with this inflationary impact that is going to come in the short term in the US, which is the global growth engine, you will see their economy slowing. Reciprocal tariffs by countries will also see demand for US exports slowing down. So, Sakshi, we are looking at possibly a global recession over the next 5-6 months. The near term hit will be dramatic, as you will see Indian markets opening gap down, and most likely 22,700 on the Nifty is what is most likely in this week. Remember, today is also the FNO expiry. So tighten your seat belts, brace yourself. It's going to be a terrible day.
Brace for impact, and that's what we have been probably saying from yesterday. And now that 26% of tariffs will be a reality for India, remains to be seen what position does the Indian government really see, take at this point in time. We are already hearing from across the world, many countries really criticizing these new tariffs by the US. Many are already contemplating what measures as retaliation to take, but this could just be the beginning of a trade war, as Shell pointed out. Many experts are already hinting at what this could lead to: a slowing down in the economy and a potential recession in the US as well. Remember, in the US markets, 2 months of presidency of Donald Trump, and the market sentiment has changed from optimism to a whole lot of nervousness at this point in time. Everybody is trying to find out what could be the impact of these retaliatory tariffs across the world. Will there be a huge bump up on inflation? What would that mean for the US Fed and central banks around the world? What positions will they take? Remember, just months ago, we had just seen the beginning of interest rate cut cycle. But will that be able to continue? Because inflation is going to be coming back with bare fangs at this point in time yet again. So that's something that we will all watch out for. Of course, there is some kind of a respite as far as India is concerned. At least on some of the sectors, pharma has actually been left out of these entire tariffs at this point in time. So there could be some silver lining in today's trading session that you see on the pharma stocks, which have significant exposure to US, such as Gland Pharma, Oro Pharma, Dr. Reddy's, Sun Pharma as well. Donald Trump has not made any specifics, reciprocal tariff announcements with respect to the pharma sector. Remember, currently India charges 10% of pharma imports from the US, while US does not charge any tariff on imports from the Indian pharma companies. So removing import duty from pharma products from the US is durable. Brokerage house Jefferies has already written in a note saying that India imports pharma products worth about $800 million from the US, while exports to the country are to the tune of $8.7 billion. We'll have to see whether that also gets reflected. There are other sectors also which are reflecting on your screens: copper, semiconductors, energy products, lumber articles, and certain critical minerals have also been left out. So there are some sectors that would probably react positively. Share.
Yeah, Sakshi, now let's look at 2 or 3 most important things that are going to happen. Look at crude oil. This is a proxy for global growth. Crude oil prices have actually dipped by about 2%, which is an indicator that people see slowing demand. Now let's look at the individual pictures of individual companies that are going to be impacted. I'll request the PCI to please fire the stock of Tata Motors. 25% of Tata Motors sales come from Jaguar Land Rover. That is also one of the biggest imported cars in the US. So Tata Motors will be worst hit. Look at automobile ancillary companies such as Balkrishna Industries. They make specialized tires. 15% to 20% of their total sales come from the US. So Balakrishna Industries will be impacted negatively. The biggest impact most likely is going to come on Motherson Sumi. About 20% of their sales come from the US. Then keep an eye out on Bharat Forge. About 25% of their total sales come from the United States, where they supply equipment for their trucks. So these are the 4 or 5 companies that will be impacted negatively. Look at Gokul Das Exports from the textile space. This company has also a very big exporter of textiles to the US. So these are 5 or 6 companies that will be impacted negatively. The only silver lining, Sakshi, that I see is that India has been hit by 26%, but Japan, China, Vietnam and Taiwan have been hit by anywhere between 32 to 46%. Vietnam in particular 46%, because a lot of Chinese companies had set up shop and their factories in Vietnam to avoid that made in China label. So Vietnam has been worst hit. In the longer term, you will see possibly some factories coming over to India because of this tariff war. But today all of us will fall. Some will fall less, and some will fall more. But today is a day where all of us will be sort of, keep licking our wounds, Sakshi.
Absolutely. We are now joined by our first market expert of the day, Mr. Anurag Singh, Managing Partner, Ansit Capital, joins right in. Warm welcome to you, Anurag. Good to have you with us. It is a tough day, and we need to find out from you what exactly should one really take in from Mr. Donald Trump's speech last night. In fact, let's start off with what he really said, and we'll take our conversation forward. Let's listen in to what the key highlights in the speech were from President Donald Trump overnight.
India, very, very tough, very, very tough. The Prime Minister just left. And he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years previous to my getting there, but it was something. If you look at Switzerland, 61% to 31%. Indonesia, Malaysia, Cambodia. Oh, look at Cambodia, 97%. We're going to bring it down to 49. They made a fortune with the United States of America. United Kingdom, 10%, and we'll go 10%. So we'll do the same thing. South Africa, 60%, 30%, and they've got some bad things going on in South Africa. We're paying them billions.
Okay, so he's actually pointed out that he's been lenient. He's only dealing a half punch to all those countries that are probably charging higher tariffs to the United States. So 26% comes to India, even though he says India is a friend, but we have not been treating US right. And similarly for all the countries. And therefore, what's your first take, Anurag?
Yeah, Sakshi, morning to you and the viewers. Sakshi, I think, so look, we are all watching the movie together. There is no, I don't have any special insight right on this. But, yeah, okay, I don't like the market corrections and everything. Nobody in the markets is liking this uncertainty and volatility around this. But I think here is and by the way, we also don't know what is the end game, right? But I think here is the broader construct of what he's trying to do. He's saying ultimately US has no restriction. If you want to access US market and if you are competitive, you can sell anything in US, correct? That has been the kind of the position of US, that we want cheaper things for our consumers as long as our consumers come and take it, compete. Now he's saying that has really taken out too many jobs out of US. It has hollowed out US manufacturing. I don't know how much of manufacturing can come back to US, but one, he might try to, the budget, the estimate is that, he might make some revenue out of it. Estimates vary from, about 10% of the overall trade that US does, so about 300 billion to 600 billion, which is a sizable number, right? Consider that the entire budget of federal government in US is about 6.7 trillion. Okay, so that is one element of it. Second element is a bit fair, which is to say that some of these countries, notably, for example, German cars, if US tries to sell into Germany, there are restrictions, tariff barriers and non-tariff barriers both. Whereas Mercedes, BMWs, Audis can sell US free of any tariffs within the United States. Why should that be? So I think there are questions on every country, and Trump is just trying to balance this conversation. I don't think these high tariffs would stay. Take, for example, India. If India were to say, tell us how did you arrive at this 52%, and then you are saying you will charge 26%. Show us the calculations, and India say, okay, we can figure this out and kind of bring this out. I think the tariffs would go away. And I think that's what every country is trying to do. Notably, for instance, Mercedes comes to US, Trump is saying 25%, but Europe levies only 10% on American cars. If they can do away with the qualitative tariffs, the non-tariff barriers, there is a deal to be made. So I think there are 2-3 broad hubs. One is European Union, it is 20%. I think it can be negotiated down to 10% or something. China is a big number. I'm sure China is working behind the scenes. The rest of the world is 10%. That probably will stay as Trump's legacy, and rest of the countries, can take their own call. That's how I believe. I don't think why it should be so difficult. If India wants to sell something to US, well, give or take some concessions. That should be okay. but we don't like the volatility that comes with it in the market. We don't have very clear idea what is the end game on this. That's how I think about it, Sakshi, for now.
Good morning, Anurag. Shail this side.
Okay.
The US 10-year yield and the dollar index are both at October lows, which is good for at least the Indian markets in the short
Correct.
term. Now, tell us what are the chances that the US, which is the world's largest economy, will move into a recession, and for that, to prevent that, the US Federal Reserve will cut interest rates that will reduce borrowing costs and refinance cost of the US debt. See, ultimately this is a game on how to reduce the refinance cost on this huge US debt that is affecting everybody globally. So one, what chances of a recession soon, and two, what are the chances that this year the number of rate cuts in the US will be far higher than what was earlier estimated.
So Shaji, you've raised a very interesting point. US is paying roughly about 1 trillion. So of the 6.7 trillion I told of the spending, about 1 trillion is the interest paid, right? Which used to be kind of about 100, 200 billion, because in the rate of zero regime, this wasn't a problem, right? So if the rate comes down back to, I mean, they're not going to be zero, but if they come down to 1, 2%, there'll be a tremendous benefit fiscally to the government, right? That's one space. However, and maybe that's the end game also, right? But there are a couple of challenges for Federal Reserve. One, the tariffs are going to be in some form passed on to the consumers, right? I understand there can be one negotiation with the exporting countries. They can absorb half of it. They can do some currency depreciation. They can absorb margins. That is one. But it's not that they can take 100% of it. So US consumers will have to absorb some of it, which will be passed on in terms of price hikes. Okay. Now, if this price hike cascades in the system and then becomes a perennial inflation problem, if this is one time, fine, it's one bump. But it is unlikely that these things stop, because then the cost escalations, cycle, it becomes a virtuous cycle. That is the risk. So one, Federal Reserve will have to wait and watch. That's what they said this time. It is too much uncertainty. We will not take any step in a hurry. Certainly, unless the inflation really cools down. So one, at least for 4 or 5 months until this dust settles, I don't think there's going to be a rate cut. Unless the other side of it is, Shalji, if if the tariffs go up to the extent they are, right? The prices will go up by 10, 20%, 30%. That will sink the consumer. Consumer so far has been holding up. If the consumer gives up, GDP will not take too much time to go from 2.5 to minus 2.5. That's going to be a problem. And that is the recession. And that's the test of nerve, whether Treasury Secretary is going to take this just like a movie we are watching, or they're going to swing into action, right? And that is, I think now people are raising serious questions that you are just going to kill the consumer.
Yes.
Unless you quickly solve this, right? So you has something to lose here. I totally agree that it's not only rest of the world. US has to take this call quickly. That's that I think so. That's the balance. We don't know what will happen if the consumer will hold up, and depends on the prices. The companies are willing to absorb.
Sakshi, what is really interesting is that Mr. Trump's ratings are already at its lowest, and this is something critical.
So Shalji, where are you taking this from? They are pretty much at the highest they've been for a president, or at least for Trump. Where are you picking this from?
Sir, I am talking about the relative rating of Mr. Trump when he started to what it is today.
Okay. Oh,
so
okay,
there is a
okay.
dramatic fall. So Sakshi, the problem here is that the end game is how to reduce the US refinancing cost of debt, and that is going to have a very, very negative impact on domestic demand of US, global demand. The global growth engine will slow because everybody will retaliate now. So now the thing is, who will blink first? Mr. Trump has already said that if you retaliate to what I have done, I will hit you back further. So it is a very, very bad situation at this point of time, and nothing better than crude oil prices and gold to give you an idea what is happening. Gold is up by about 1 percentage points, fresh record high at about $31.54 an ounce. Crude oil is down 2 percentage points because we are looking at weakening global growth. So, this is a very, very big problem, and let us see how it gets solved. There seems to be a hardening stance by everybody. Look at Sakshi, what you were pointing out, GIFT Nifty 1 percentage point lower. We are already below 23,000. Wait for 22,700. It's coming, and possibly, I hope I am wrong. I am wearing a green shirt, Sakshi is wearing a red jacket. We are doing everything we can to keep the bulls happy, but the Nifty low of June 4th will be tested.
Yeah, it's moving there. Yeah, it's okay. Shalji, can I just object to the retaliation concept, right?
Please do.
So this is the Trump is saying this is US, this is our retaliation. Like there's no retaliation on retaliation. Look, he's saying the countries have tariffs. They can't deny it, right? So he's just saying whatever you tariff me, I will tariff you, right? Now, it's not. I don't know how it can come up in a retaliation war because ultimately US was the only place where they were not levying tariffs pretty much on almost any of the goods, right? So I don't see how Europe can retaliate, or I don't know how China can retaliate, but to negotiate, right? So that is on the retaliation aspect. I don't think that is wise. And Australian PM, for example, by the way, has been pretty moderate and tempered. He said, we'll not retaliate. We expect it's not a great move, but we understand. We'll absorb it, right? And I think that's the move. United Kingdom similarly, it's 10%. I think that's okay. They can absorb this. So I think it calls for a very pragmatic move. I think what he's done is this global peak globalization is behind us, right? What he has done is that look, every country has to carve out their own space. So if India works, Modi can work out a deal. I'm sure the leadership is working on it. It'll be good for them, right? So it's just that it'll not be as free. So US market is available. There is some cost to it. That's the limited, I think, point he's trying to make.
Absolutely.
I think that's where it's going to probably end.
Right. Anurag, government sources have already told Business Today television this morning that they're analyzing the US tariff impact and they may issue a detailed statement soon. They also have believed to have told us that indirect macro impact could be bigger than a direct hit. And they're also saying that as per Clause 4, US may cut tariffs if the concerns are addressed and they want to put their best foot forward. So those are the early statements coming in from government sources to Business Today television. Let's see how that one is carried on. Thank you so much, Anurag, for this morning. You're sparing your time and sharing your insights on this important topic. Viewers, we have a stellar lineup of guests, and the next guest who's joining in on the program is Punita Kumar Sinha, Managing Partner, Pacific Paradigm Advisors. Warm welcome to you, Punita ji. Thank you so much for taking the time out. You've been up and about all through the night, attending to calls, speaking to various people, analyzing what has gone on into the speech and what would be the impact. I want to understand from you the top 3 takeaways from the speech and what would it mean for India?
Well, first of all, interestingly, I'm in the US, so I heard the speech live after market close, and I saw the extended market already reacting quite negatively almost immediately. The US markets were down, Nasdaq was down. And while everybody was expecting tariffs, I think there was it wasn't fully priced in. I mean, that's clear. So my 3 takeaways are that one, I think there will be a hit to earnings. From what I'm reading, that number could range anywhere between 1 to 3%, depending on the sector, on earnings growth across the world. I'm not just talking India. And autos and electronics probably globally are going to be more hit than other sectors. So that's one. Second, I think each country is going to figure out how they want to respond. And some countries might devalue their currencies to offset the tariffs. Some might have reciprocal tariffs. Some might negotiate harder, and some might look for other trading partners to replace what will be a slowdown from their US trading. And third, I think this would result, at least in the near term, some inflation, particularly in the US. It would result in a growth slowdown, perhaps globally, because a lot of export-oriented sectors across the world are now facing uncertainty about their own exports and where they will find new channels to export to, which could be more competitive for them because depending on the tariff, your exports could be have become uncompetitive to the US compared to other countries. So those will have to be analyzed. So businesses will really have to think hard about how they are going to maintain their growth. So this obviously raises uncertainty, and along with inflation risks and along with potentially slowing economies.
Good evening, Punita. Shail this side. And one thing is very clear, you had voted right in the US elections. Sadly, the impact of that is now felt globally. As far as India is concerned, what do you think are the key positive takeaways? We don't seem to have been hit on pharma, and that's reflecting very, very well in pre-open. You have stocks like Aurobindo Pharma, Zydus, Divi's, Lupin, Dr. Reddy's, Glenmark, Cipla. Actually, in the FNO gainers, the first 10 are all pharma stocks only. So, pharma is safe. How do you see Indian IT reacting? Because slowing US growth will mean lesser work for our software exporters.
So hardware is more impacted than software services, I think, obviously. Now on Indian IT, if there is US slowdown, it could definitely impact IT budgets by companies. But on the other hand, if manufacturing picks up in the US, as President Trump is hoping that it would force production to be relocated to the US by many, many companies because of the lower tax regime and perhaps some incentives, then maybe there will be more demand again for certain types of software services. So it's hard to say, but yes, I think based on how the stocks have done so far and the valuations, could there be some downside? I would say potentially yes.
Punita ma'am, I wanted to understand, what are the choices available for India to mitigate the impact? So far already we are hearing from the government sources saying that they are analyzing, they may issue a detailed statement, and they also have pointed out that as per clause 4, US could actually cut tariffs if the concerns are addressed, and India wants to put its best foot forward. So what are the choices that we have, and how much can we actually mitigate the impact to really protect the domestic industries?
Well, I mean, we could lower our tariffs, and that would mean that US would lower their tariffs. So instead of raising tariffs, we could lower our tariffs. So I think that would be one potential response. Um, Second would be obviously on the currency. If all the global emerging market currencies try to weaken, then that would offset some of the tariff increases. And so I think that, of course, is not in our control, but it is sort of a global, coordinated effort that might happen on its own naturally as certain currencies start to devalue. That's another response that might offset, and some of the tariff increases. Um, and I think what we in India need to do is to really focus on boosting our own domestic consumption, boosting our own manufacturing sector, to be able to, be efficient, cost competitive, so that, we remain competitive despite the tariffs, and we still become a preferred source of supply to US consumers because we are efficient. I think it will force some discipline onto our companies to be able to be price competitive. despite the tariffs.
Punita, you run a global portfolio of equity assets across the board. How are you now tweaking your outlook and portfolio to reflect new realities? And how do you see gold now in the medium term? It is already at a record high and crude oil is slipping. What is the view on global equities? Where will you shift money? And on
No, I
commodities?
think, I think global equities are definitely going to have an uncertain and volatile year. We just had a correction, then a rally, and now perhaps another correction might be ensuing. And then there could be another rally depending on what the negotiated, in a few weeks, there'll be a lot of negotiation and things could be quite volatile because you could get good news and negative news depending on country by country and what each country does and whether tariffs are rolled back in some cases. So it's very hard to say. So I think it's definitely a volatile period. Um, and it is, in a way, a trading market. So if things really correct, then you assess and perhaps enter more aggressively. But at the moment, I would say that you should be in safe defensive names and have some dry powder, which you have some cash in your portfolios, so that if you can get a better opportunity to invest it, which you might get, that means there could be some correction at some point. And so I think having cash is a good asset class alternative right now.
Wonderful. Having cash is a good asset class that you would have at this point in time in your portfolios. Barring the pharma index, all the other sectors are down in the red. The pharma is a bright shade of green. In the pre-open, we have a near 3% uptick on the pharma index. All the gainers on the Nifty are pharma. Dr. Reddy's the top mover, 3.5% higher, indicative and implied open. Sun Pharma, you also have names in the F&O space, as Shell points out, Zydus Life, Oro Pharma, Lupin, Divis, all of them upwards of 4% kind of a move is what we are seeing. This is a relief kind of a move that pharma has hit in trade today. Punita ji, how would you really look at Indian market sectors and deployment there in case you are sitting on that cash that you talked about? Where will the fresh deployment be? Do you think it will be Sands Auto now, since that has been clearly seen as the biggest, hardest hit space? And how would you really shift your deployment within the sectors in India now?
Well, some sectors, are still like pharma, for instance, while it's exempt right now, it's not, a judgment hasn't been fully passed. It's still being reviewed. And we don't know what will happen. And I think they have about 270 days or something to come up with another list and as to what will remain exempted and what could come back into the tariff regime. So I think that that evaluation is still on some of the sectors that have been exempted. So, and again, as I said, it's very hard to predict whether some tariffs will be removed, rolled back, or increased based on how the negotiations go between India and the US. So it's very hard to make a prediction on what sector might benefit, but one sector that obviously will never be impacted from this in a direct way is the financial sector, which is lending to the Indian consumer, the Indian corporate. There will be some slowdown potentially to the Indian corporates that are exporting, but the domestic consumption story is what will not be as impacted by the tariffs. It's more export-led sectors that are impacted. So I think those are the spaces and sectors that you should be focused on for this year. And if there is severe correction in some of the other sectors that are linked to the US, very heavy trade-oriented sectors, then if they correct, then the valuations look attractive and looks like things are priced in, and that the companies are able to manage this transition well. And so that means you have to really be listening to company management's commentaries, how each company is adapting to the new tariff regime. How are they shifting their exports? Are they beginning to shift to some other countries? Are they beginning to even tap into the domestic consumer more in India? All of that will require more work and analysis, company by company. But overall, I think certain sectors which are very domestic led in India, whether it's financials, travel, tourism, hotels, those sectors will remain relatively defensive, the consumer staples, etc.
Right. Thank you, ma'am, and have a good night's sleep. We hope to meet you in person when you are back in India. It's a negative start,
Thank you.
ladies and gentlemen, as far as the market is concerned, but it's a knee jerk. It's not as bad as one would have hoped. 129 down on the Nifty, 23,200. Let's look at the top performers as far as markets are concerned, and you have the entire pharma space in the green. In particular, Zydus, Aurobindo Pharma and Dr. Reddy's. Anywhere between 46 to 48% of their of their total revenue comes from the US, which is unimpacted by this tariff problem. The Nifty Mid Cap 100 index is down 0.5%, that's 250 points. Small cap index is actually, Sakshi, not down at all. The Nifty Bank down 350 points. And the IT index is going to be the worst hit. Let's see what IT is doing at the moment as far as prices are concerned, down 2.5%. I'll also request the PCR to show Gland Pharma. This is up 15%. I'll request the PCR to show three other stocks. Tata Motors, where 25% of sales come in from JLR. Motherson Sumi, 20% of sales come from the US. And of course, you will also look at Balkrishna Industries and Gokuldas Exports. These are the companies that are going to be impacted negatively. Motherson Sumi, actually Samvardhana Motherson. Sakshi, what are you watching?
Absolutely, Shell. So it's the pharma space. The index is up 4% today with Gland Pharma leading, 9.5% higher. Oro Pharma, Dr. Reddy's, Divis Laboratories, Zydus Life, Lupin, all upwards of 5% kind of moves that can be seen. All the stocks on the Nifty Pharma are in a bright shade of green. That's the sector that has been left out from the tariffs, and therefore you see this strong reaction on that front. India VIX is up 2.3% at 14.04, but IT 2.5% down, autos down over 1%. You also have other sectors like realty, pharma, realty, FMCG and financial services also down in trade. Let's welcome our two other guests who are joining right in on the broadcast. We have Vineet Bulinshkar and Mitesh Panchal joining in on this program. Warm welcome to both of you. Vineet, good morning. We've been assessing the impact. Tell us, does pharma become a critical part of core portfolio after it's been left out from the tariff war?
So pharma not only becomes a critical part of your portfolio, but also becomes a growth engine of the CDMO stocks.
Yes.
We believe that CDMO is going to see a substantial upswing taking place, and stocks like Laurus Labs, your Strides, and the others are going to see some very, very strong allocations happen. And pharma is a common sense decision by the president to leave it out because it ultimately affects your well-being and existence itself.
Right. A very good morning to you, Mitesh, and a very warm welcome, Vineet, as well. Mitesh, first to you, anything you want to do in this market which is now completely skewed towards pharma, your top pharma pick, and your broader view on the Nifty from now on?
Good morning, Shailendra. Nice to see you after a long period of time. Good morning, Sakshi. Good morning to other panelists. Good morning to all our viewers. First, let's come to the question pharma. I think what we like is Sun Pharma at the current level. We are of the view that Sun Pharma is in the next leg of a strong up move. So probably what we are looking at is around 1900 plus levels. Apart from that, what looks good as of now and the broader view, we are of the view that's what we have discussed last time with the Sakshi, that for the financial year 2025-26, what we like is the PSU, irrespective of the sector. And the broader view remains the same, that these are the beautiful moments where you will get something at a discount. So use this, keep aside the tariff war and the noise, we are of the view that 2025-26 is going to be a great year for the bulls. So advisable to use any dip going forward which is available for accumulation. So the broader view goes like this, that we are buying every dip, we are concentrating on PSUs, and market is here to reward going forward.
Okay. Vineet, let's come back to you. And, what else would you do, say, on auto and IT, which are seemingly the worst hit today? Autos, of course, that 25% tariff announcement goes into night. So that's the first one to get impacted, right? With the tariffs which come into immediate effect. And then thereof, April 5 will see the baseline get into impacted. We'll also see April 9 when the 60 countries will actually see the tariffs that have been announced overnight get implemented. But autos, straight from today, auto and auto components, what do you have to say on that?
So, two things. One is India is already in a, kind of a slowdown phase in terms of autos, and auto banks are going to get impacted. So, best is to stay out of this sector. Uh, if you would rather be in this sector, I would look at Bajaj Auto and other players who are in the two-wheeler EV space. They seem to be doing well, and Bajaj Auto has seen some very good numbers for Gudi Padwa. So that is one stock that I will be buying into. The other things are that this global meltdown, this is going to happen. There's going to be a consumption shock in the US and a global supply glut. This is going to lead to softening of inflation initially, and India is going to benefit from this. And we've already seen rates dip in India. So, that is going to be a very good situation. I'd like to draw comparison to what we saw during COVID. You had a supply shock and lower interest rates, and we had a rally takeoff. This time around, we are having a consumption shock, supply glut, interest rates down, and I think this portends very well for the Indian markets. We think that there could be a few more days of fall in this market, but after this, a multi-month rally will play out because India is a very insulated market, and software will get impacted because there is going to be a meltdown in the Magnificent Seven stocks. So clearly you avoid autos, you avoid IT, focus on consumer durables, other consumption stories, and pharma as one of your growth engines.
Right. Vineet, how about private banking space in India and NBFCs? They are 100% oriented towards the domestic market. And of course, valuations were pretty good about 15 days ago. They have been taken advantage of by all those sitting on cash. What would be your view on private sector banks and large NBFCs such as Shriram Finance, maybe even Bajaj Finance?
So, as we spoke about consumer durables, the proxy play on this is going to be Bajaj Finance. We think it will do well. And, this could be the bellwether for listing of HDB financials and other entities. So this could, be a virtuous circle that plays out. Bajaj Finance will do very well. Muthoot Finance is obviously going to do extremely well given that gold prices are hitting all-time highs. And Cholamandalam and your Shriram Finance are definitely going to do well because your cost of funds is going down. And that means, music for the years of these NBFC guys.
Mitesh, coming back to you, the other sector that is probably, shining brighter is the textiles and the apparel space as well. Gokul Das Exports is up 5%. You also have many others joining the fray, Vardhaman and all those others as well. Now, we've also heard from brokerage houses saying that the textiles and apparels, the tariff edge creates opening for the India market for the US, vis-a-vis, say, a Vietnam or a China, which have been hit with harder tariffs as well. What would you really do with the textiles and apparel space?
As far as textile and apparel space is concerned, Sakshi, from the beginning, one stock which is unfortunately not doing well, where we have the highest conviction, is Ambika Cotton Mill. So I think that is where we are concentrating. Apart from that, we are not playing any other stock in this space. So Ambika Cotton Mill is what we are looking at currently. Stock is trading around 1344. Probably sooner than later, we will get back to those levels of 600 and 1800. So this is the time, if you don't have any exposure to textile in your portfolio, advisable to add Ambika cotton mill at the current level.
Right. That's an interesting thought. Apart from Sun Pharma, Mitesh, what is your view on the private banking and NBFC space? Any favorites in these two sectors?
As far as private banks are concerned, Sharji, right from the beginning, we are bullish on two stocks, and the two stocks have performed pretty well so far. But the marathon run has not begun. First is HDFC Bank, second is Kotak Mahindra Bank. As far as NBFC is concerned, I think we need to really wait for one more quarter. I think April, May, June, where we will get a quarterly chart pattern of the new financial year. After that only we'll be clear about the stock performance in NBFC. But as far as private bank is concerned, we are of the view that the HDFC and the Kotak Bank has just started. There is a long way to go.
Vineet, coming to you back on the IT talk, IT space, which has been, although showing a lot of weakness of late, last 3-4 weeks or so. Every time there is this Trump tariff talk, IT sector is the worst. Even today, it's down by about 1.5%. Remember, when the presidency shifted to US, to Donald Trump, things were expected to be better for Indian IT firms, looking at how businesses could loosen their purse strings, client spends could actually increase. That could augur well for the Indian IT firms. But things are changing with these new announcements and change in trade policies. Earnings are going to be starting off in the next 8 days or so, with TCS reporting on 10th of April. What exactly is your thought on the Indian IT firms?
Sakshi, I think for the longest time, 18 months almost, I've been extremely bearish on this sector. Rather, more than being bearish, it's been an avoid. And, this thesis of mine played out very late, but it is playing out in the right direction. And I believe that the IT stocks are going to sell off. We're going to see a massive sell-off happening in the Max 7 stocks, as I said. And with the overall slowdown shock that the US is going to see in the next few months, IT spending could take a hit. And on the back of that, I think it is best to stay away from IT stocks. Apart from that, the pace at which AI is progressing, it's reducing the redundancy. It is making consulting redundant in the US. And when consulting is getting redundant, IT also follows because, bulk of your activities can be done internally at a fraction of a cost. And if that is a possibility, then, you will see top line as well as margins under pressure. And the operating cash flows which these companies have been, cash machines, I think is going to come in for a challenging time.
Right. And yes, for those who've been listening to Vineet on Business Today Television, he has been very, very negative on the IT space for the last 2 years or so. As he says, it's worked out late, but it's fine. When you look at, Vineet, the broader theme, one must understand that making America great again was a political slogan rather than something that Mr. Trump expected to happen overnight. One, do you see factories shifting to the US in the medium term? Two, is this all that we see, a broader game plan of reducing refinancing costs on US debt and possibly making America a little more insular than what it was earlier?
You'll have to bear with me for a longish answer. But I'll try to be as brief and swift as I can. See, the debt consumption, the debt position of the US is absolutely untenable. And, if you want to kickstart your economy, you have to hit consumption, because when you lower consumption, you can bail out the debt situation. Secondly is, there's a lot of debt which is going to get renewed or roll over, and it's close to $8 to $10 trillion. And for that, you cannot roll over at 4.5%, 5%. They would want to get the rates lower. So, I think Trump has worked out a strategy where he uses this situation to the best impact. When you when you raise tariffs, you hit consumption. Consumption is obviously going to come off, because, a 25% tariff hike on an average, and, add a little margin for the players, you're hit by, your expenses are going to be 1.3x. That is going to hit consumption, cause the economy to slow down, get the interest rates down, roll over the debt. Already $300 billion of manufacturing has been committed to the US, and use these tariffs to lure companies to come to set up manufacturing base in the US. At the same time, negotiate with these countries to lower tariffs, make US exports more competitive, and and all these salutary actions that have happened are going to cause the dollar to weaken, making their exports even more attractive. So he's trying to build an engine of growth, cut back on consumption, cut back on fiscal spends, get your other measures in place, and he's trying to work it out. But I think he's firing on too many cylinders at one time, and somewhere this story could derail. But anything that happens negative for the global economy is going to be positive for India, because we are a very, very insulated economy, and we are going to benefit from translation of manufacturing from China to India.
Fair point. Well, Vineet, thank you so much for sharing such wonderful insights that really help our viewers understand the close impact of Trump tariffs and what could we expect going forward from here. This augurs a longer discussion, and we will keep inviting you throughout the course of the day and the days forward as well to really understand the fine print of what could be coming in for India and how should retail investors be prepared. And thank you so much, Mitesh, as well, for being with us and sharing all your thoughts on the markets today. Let's actually get two other brilliant experts who are now joining with us on the program. Let's get Mr. Nishal Maheshwari, who's joining in on this program. Warm welcome to you, Nishal, and thank you so much for joining in. And we also have another guest joining in. We also have Mr. Manish joining in. Warm welcome to Manish and Nishal. Warm welcome to both of you, and thank you so much, sirs, for joining right in. Manish, sir, first up, of course, we've been looking at the fine print and gauging the impact of 26% versus a 34% on China and versus higher tariffs on the other countries as well. I want to understand one key point from you. We're thinking of whether India has a chance to negotiate, bring this tariff down. Maybe it is possible in the days to follow, months to follow. But if it is not going to be just India, the impact that government sources are already telling us will be largely felt by what happens on a macro economy point of view. What happens worldwide. If that really, slowdown happens, if a recessionary impact happens in the US, then how are we going to get indirectly impacted? Tell us your first thoughts, sir.
Yeah, so that's the second order impact, and it's a given that in the short term, US is going to feel the heat on growth because, supply issues cannot be addressed in the short term very quickly. So there will be a hindrance for the American consumers to purchase with increased prices on account of tariffs. And that's going to basically manifest itself in the form of either stagflation and even 35-40% chance of a recession coming through. That's a second order impact, and the global fallout will be seen across the board, across the countries. That's a given. And obviously, India will be not immune to that aspect as well. So we have to live with that. I mean, if manufacturing has to come back to the US, it can only happen in the medium term. Repercussion of all this is going to happen on currencies. Obviously, US dollar is going to be feeling the pressure of either a stagflation or a recession coming through. And vis-a-vis major trading currencies of the world, the yen and the euro, it might weaken. And that's again going to have a second order impact on exports and imports in a big way, apart from the tariff issues which has just now got unveiled.
Right. Namaste, Nishchalji. A very warm welcome to you. We will need all the wisdom and all the knowledge at your disposal over the last 30-35 years that you have gained on how to navigate this intense volatility that is now upon us because of this global tariff war. How do you see Indian markets, and what are the opportunities and threats that are upon us?
Thanks, for inviting me. Thanks, Alice. I think one thing is becoming clear basically that there is going to be increased volatility, not only in terms of the market, but also in terms of the business across the world, as US has now started with a unilateral announcement, and then it's going to go in for a bilateral agreements across the world with different countries. I think that is their plan, and I think that's what they are going to eventually do. But that will happen over a period of time, and that will create uncertainty. And I agree with Manish that there is a fair chance that US may go through a stagflation, basically maybe a quarter or two of recession, and that will impact the world across basically, as US still remains to be the major consumption bowl of the world. Now, how do you play this basically in this time of uncertainty, at least for the next 2 quarters? What I see here is basically two things. One is focus on domestic industries, which are largely India facing, and there are several of them, and they are doing okay. I think whether it is one of the major ones is basically government's spending. So whether it is the beneficiaries could be cement, beneficiaries could be construction, beneficiaries could be construction equipment guys. So I'm saying there are several of these industries which are domestic facing, whether it is consumption, retail. I think there are a lot of industries basically which are totally domestic facing. So focus on that. India that way is a fairly insulated in country. I think 22% of their India's GDP is exports. There also, I think pharma and IT has been spared. So something silver lining. So in the next 2 quarters, focus on the domestic side, focus on individual companies, because even within these sectors, as we have seen, India is going through a issue as far as earnings growth is concerned. So you have to be very, very focused. But avoid international export companies which have too many linkages abroad. I think in the short term, just avoid them, because yes, there may not be any direct impacts, but the second level impacts could be many.
Fair point. Mrs. Sonalia, I'll come back to you, and I want to understand from you, how would you play a pharma vis-a-vis auto at this point in time? Seems like it that pharma has been left out, and that is, displaying a clear win kind of a move at this point in time, a relief kind of a move at this point in time. But looking at how the fundamentals have played out, this may be just a trigger of a relief. But do you really see from here on pharma will continue to give you additional upside, or should one not go all guns blazing on pharma, looking at just this tariff relief that has come in? Vis-a-vis what happens on autos, those are the first segments or the sectors that have that 25% tariff going right from tonight. The first hit sector is auto at this point in time worldwide. So how would you play pharma vis-a-vis auto now?
So before I answer that question, one additional important point that I would like to highlight is that China's duty is around 54%. India's duty is going to be 26%. So I would broadly think that this is a golden China plus one movement for India. If with a differential duty of 28% between China and India and a purchasing power parity of 2x that of China, if we are not able to increase our share of global trade with the US, then we'll probably never be able to do.
Okay.
So, this is an opportunity in the making. Coming to the question of pharma, I mean, it was very clear that, pharma could not be taxed, given that the cost of manufacturing of pharma in the US is multiple times that of what it is in India. And if Indian guys are not able to make 20-25% ROC exporting to the US due to price erosion and other things, American manufacturers are in no position with the high cost of manufacturing to cater to their lower cost of Medicaid. Cost of medical is all very high in the US. So
yes,
I think, so pharma is clearly going to be a beneficiary, and India's share is only going to go up because China is facing massive issues on that count. But we have to be mindful of the second order impact of the excess capacities that exist in China, and what sort of non-tariff barriers do they exercise. In the case of KSMs and APIs, of which India is a big importer and we make the formulations and export to the US, we have to be mindful of two aspects. One is the dumping of Chinese products into India, destroying industries worldwide because they'll be left with excess capacity and because they won't be able to export that much that is there going to the US. And the second is basically non-tariff barriers in terms of creating embargoes on important raw materials catering to some of the industry. Automobile is going to be a clear disadvantage, not so much in terms of volume, but more so in terms of EBITDA margins, because that is, and this is basically both autos and auto components. In some time, we'll see that. But India really does not export too much of OE products, which is the manufactured cars and motorcycles, etc. It's basically the auto com space, our US, and engineering goods. These are some of the areas which can get negatively impacted because of an immediate announcement of this 26% tariff. So key vulnerabilities are basically auto and capital goods, according to me, given that India exports around $87 billion, four major items, gems and jewelry, capital goods, autos, and pharma. These would be some of the key items. Pharma has been exempted. Gems and jewelry, we re-import them. And, the two left outs will be autos and, capital goods.
Fair point. Nishal sir, just wanted to get a sense going. The reaction in the market is probably saner than what we were, expecting. What do you make of that? 23,259, we're not as bad as we had, were thinking to be. Do you think the worst of the tariff impact is already priced into the markets, what we've seen in the run-up to the April 2nd announcements? I mean, from February onwards, the kind of fall that we had been witnessing in the markets. Do you think the worst is already priced in and we are now on course on our own fundamentals and domestic recovery triggers?
So I think it's too early to say that because US and Mr. Trump, he might do whatever he wants to. So it's too early to rejoice, but it's a big relief basically because after seeing yesterday's, because the tariffs are much aggressive than what market was expecting, and then there was reactions across the world. I was expecting at least the Nifty to open at closer to 23,000 rather than actually 23,200. So it's a very good relief. But it's too early to say that only the fundamentals, we need to worry only about the fundamentals, because I think this is just, as I was telling you, it's just opening the table. And now I think the broader bilateral negotiations will happen. I think India is already on the front foot there. The government is negotiating early there. So I see a positive outlook. I see a positive outcome of that. But I think it's a bit early to rejoice.
Early to rejoice at this point in time. Mrs. Analia, I'll come to you as well. In case we are working with that, volatility may continue. We may see a lot of announcements even after today on tariffs, and, uncertainties could perhaps keep coming in as headwinds to the recovery path that we are on the Nifty. Then how would you advise an average retail investor to really continue to focus on building that crisis resilient kind of a portfolio and keep your eyes on the long term and let things pass at least for the next few months?
So the big call is that the US dollar is going to depreciate, and obviously, India is going to have a second order impact on the currency. Indian currency was depreciating massively, and that has obviously halted due to the depreciation of the dollar index. And I think this is basically the main reason why emerging markets are holding out. Now, there is one school of thought which believes that equity risk premium across emerging markets may go up. But there's another school of thought which believes that because the US is going to see a massive depreciation in their currency, there can be a shift out of dollar assets and move into other assets across the world. There is a case of decoupling. Obviously, we have never seen this sort of a massive decoupling. But mind you, in domestic markets, we are looking at two major rate cuts coming through in April and June. That's going to be a silver lining as cost of capital comes down. 23% of our exposure of GDP is on account of exports. Balance is all domestic. We produce and consume domestically. That's not impacted at all. And within that merchandise exports, it is just about $87 billion worth of exports. And obviously, government is on the job to enter into bilateral agreements because US is just bothered about reducing the deficit with the surplus with India, which is around $47.5 billion. If we were to shift our energy import basket from, let's say, other countries to the US, obviously that problem will be solved, and it's a solvable problem according to me. It's a matter of time. So I think it is a golden moment. It's a buy on dips. I would strongly stick my neck out and believe that 22,000 on the Nifty might be defended very well, given that domestic flows are still very good. It's still about 30,000 crores in the month of February when there was all gloom and doom all around. Retail participation is there. And, I would believe that it's a golden moment for India. Everybody is in the same boat as far as the reciprocal tariffs is concerned. We are not that badly impacted as the likes of China, Vietnam, Thailand, Indonesia. If we can compare themselves to us, then basically we have a clear advantage and an opportunity. I think Indian corporates and manufacturers will take care of this and seize the opportunity. I would be basically quite bullish on the markets from these levels and, would look to buy on the dips. I would believe consumption is the mainstay. The next leg of growth in Indian markets will come on account of consumption. BFSI and pharma, these are clear standout winners as far as the today's announcements on tariffs.
Okay, hold that thought there. I'll come back to you on the three sectors that you've named, consumption, pharma, BFSI. Those are the places that you believe things could shift to. But Nishchalji, I also wanted to get a sense, we've seen a reaction on gold that continues to rally, looking at all these uncertainties and as how talks have progressed on how slowdown could occur, inflation could rally, everything that sounds good for a gold bull. What would you really, look at the current space and the levels that we are on gold, and would you at all be extremely bullish, or would you be cautious after the rally that we've already seen on gold?
My comment on that would be at best a guess. I am no expert on gold. I only understand or claim to understand equities. That's all. But I would say, I think something which has rallied so much, I think there is going to be some reaction, some profit taking would happen. I would say, given this kind of uncertainty, one should remain invested in gold. But incrementally, as an individual investor, I would tend to put more money on gold at the moment because things are changing as we expect dollar to become weaker. I think things are going to be not in favor of gold as we go along. So I think hold on to your positions because there is still uncertainty, but incremental investment should be done in gold.
I'll want you also, Mr. Sondhalia, to talk about how would you really look at, precious metals, because we've been hearing in the run-up to the rally that we've seen over the last 2 years or so that gold and silver now at least should be a part of the core portfolio, have 10-15% kind of an exposure in case you're a long-term investor. What exactly is your thought here?
No, so I'm quite bullish on the precious metal space. I would believe that the US dollar has a case to depreciate at least 5 to 10% from these levels. And obviously, if the dollar depreciates, then and there is an environment of stagflation in the major growth engine of the world, which is the US, 25% of world's GDP, then obviously gold and silver acts as a safe haven to protect your asset value. Central banks all over the world are piling onto gold. And I would believe that the precious metal, gold and silver have further upsides from the current levels. God knows where they can head to, but they can surely be upside from the current level.
Okay. Nishchalji, coming back to you, tell me, after the overnight announcements on tariffs, does anything change for an investor who may be looking at a global diversified portfolio? How will things change if you yourself would look at an allocation globally now?
So I would actually pull out money across the world and say, come and invest back into India.
Wow.
Because that's where you are safe at the moment. India is a fairly insulated economy. Look at the domestic plays, which are still doing well. By the way, India still continues to remain I think the topmost performing economy as far as GDP growth is concerned, that is being projected for the next year. So So I think if you want to see growth, I think there are very good companies out here. So I think pull out money across, because that's where there is huge amount of uncertainty. Other countries, how they are going to react, because I think this is just a one-way tariff basically with the US export. Now we have to wait and see how each of these countries react to it. So that's the problem basically, and that's why I would actually pull out money, because at least we are very clear about what is the stance of the Indian government. So pull out money across and come back to India.
Pull out money across and come back to India. India is your best, place to invest in at this point in time. And Mr. Sundalia, if I have to ask you as well, how would you really look at FII's position now? They have been net sellers of the Indian equity markets. Do you think these fresh triggers will provide a case for them also to return to India?
100%. I mean, there have been big sellers in the market over the last 1.5 years, and the key reason for the selling was the overvalued Indian currency. That aspect has got corrected. We have depreciated to 88 and now at 85. And if US dollar was to depreciate, obviously they'll look to protect the value. India will be one of the highest growth rate countries in the world, even now 6% real GDP growth. Inflation is quite benign. Liquidity is easing at the margin. Plethora of opportunities in the Indian markets, and domestics are also participating in. So where will you get a country which is growing at 6% in real terms and you are able to diversify out of India? Obviously, there is one aspect which needs to be catered into, which is valuation. In India, nothing is worrisome except the valuations. I would believe that if you are able to take care of the valuation and are certain about the growth on these companies, I mean, there is no case for being bearish in India. And the second biggest asset allocation will be your gold. And the third largest would be basically your duration on income, which is basically you're looking at 50 to 75 basis point cut in rates in India. And the difference between US interest rates and Indian interest rates have never been so conducive as far as India is concerned. The spread has narrowed significantly, which highlights the strength of Indian economy vis-a-vis the rest of the world.
Okay. Nishal-ji, do you think there is a case for the RBI to again cut rates then, looking at what is, how things are changing on a macro space?
I think RBI has already bit that bullet earlier. Basically, I think now there is a very strong case basically to go ahead and keep on doing that. I was a bit skeptic in the first rate cut, because at that time, basically, given that you had a huge pressure on the rupee, so I was a bit skeptic at that time. But I think given that we have bit the bullet there, I think you look at each of these steps basically which RBI is taking, rate cut, introducing liquidity. So I think RBI is supporting. They have understood basically that now is the time to go out and support the businesses, support the economy, and that's what they're doing. So very sure basically that there is going to be a rate cut in April.
Okay, fair point. A very short bullish expectation or optimism as far as a rate cut possibility in April is concerned. So that's something that's the next big trigger that the Indian markets will be watching out for days from now, and we'll be focusing on that. Manishi, you talked about three key themes: consumption, pharma, BFSI, where you're bullish on. Tell us how would you be really going about selecting stocks within the portfolio now? Would you be allocating more money here? What exactly is the thought process on this space, especially on consumption? Because why I'm asking this is April 1st has started off. This is when the budget announcements were really focused on reviving consumption, putting more money in the hands of people. Where do you think in consumption one should be focused on to take that benefit?
Yeah, so, the pendulum has shifted away from investment-related themes to consumption-related themes. Broadly, if you see that, April to February numbers on capex, etc., we'll be barely meeting that 10 lakh crores mark for fiscal 25. Valuations still prohibitive as far as the investment-related themes are concerned. You have a tax saving of 1 lakh crores, particularly for people who have income less than 12 lakh rupees. Obviously, discretionary consumption is the one which is going to benefit. So whether it be, let's say, durables, whether it is Medicaid, or whether it is your two-wheelers or automobiles. And mind you, the full-blown impact or positive impact is not going to be seen immediately in 1 or 2 quarters, but the second half of this year. And you'll start to see the rub-off effect of all these things. Rural economy is also coming back. And I'm not so bearish even on the staples piece now. given that valuations have corrected, you will have income in the hands of people, particularly rural income. These are going to be benefiting at the margin. You look at hotels, you look at travel, you look at some of the leisure, entertainment. These would be some of the areas where I think consumption, QSRs, these will be some of the areas where I'm particularly quite bullish on consumption, discretionary more than staples, urban
Okay.
more than rural.
Okay, fair point. Nishal you also mentioned so many themes, including cement and all the domestic focused sectors. Why don't you give us some names? What kind of select names can we really look at adding to our portfolios now?
So I think a couple of themes which I was talking about is the government spending. And there are two or three sectors basically which continue to do well. Power is one of them. I think the orders have been huge, especially on the T&D side. So there are several companies out there, and I think one can look at that. There is then the domestic construction companies again, where there are huge orders. Cement is a beneficiary again there. So I think these two, three themes, one can look at it. On the consumption side, I think we are seeing good traction coming back. At least a couple of companies were declared the third quarter, not the numbers, but at least the business update. They have said that at least they are seeing some traction on the rural as well as on the urban side. So I think some of these companies on the retail side should be looked at. So I think these are three or four domestic themes one can play.
Okay, Nishal tell us also what remains in the avoid list or a complete caution where you would continue to advise, sir.
So I think export oriented IT is one of them. Basically, I wouldn't say avoid, but I think it is on a cautious list because the sector has corrected quite a bit. That is one of them. And anyway, the sector had an issue as far as earnings was concerned for the next year. So I think that is a caution thing. Auto is another one. We have to see basically how the tariffs settle. So I think these are two or three sectors. Gems and jewelry, we hardly have anything there are no big exporters which are listed. So that's why we do not have much of issues. Textile is another one. Basically, we have to see if these are three or four sectors basically which are directly impacted. These are three, four sectors basically one should look at. Specialty chemicals to an extent, we have to see how things pan out there. So these are 4 or 5 sectors one should be cautious about.
Okay. Manish how about you? What would you absolutely not look at from here on for the next at least 6-8 months?
I think autos are a complete avoid and capital goods. These would be the two vulnerable areas, more so on account of, the capital goods space, etc., more so on account of valuations. They are still a hindrance and automobiles, obviously, the main brunt of US is basically centered around automobiles and auto components, and India has a large portion of export to the US in terms of auto comps. So this is one area will be clearly an avoid. Renewables, again, valuations, major issue, plus the dumping, duties which are now being introduced, reciprocal tariffs, plus what is going to happen with China, introducing and dumping worldwide. These are some of the major questions left to be answered, but at this point in time, these would be basically valuation issues, clear avoid sectors.
Manish I have to ask you before I let you go both. You both are pretty bullish on India henceforth, and you do believe things will turn for the better. FIIs to return, and of course, India being seen as one of the brightest spots for investments at this point in time. What are the chances, Manish? Do you see us touching those erstwhile highs, 26,277, sooner than we expect, sir?
We will see it in FY27, give or take a few months here and there, but definitely 26,277 is par the course, even with the 10% sort of a growth in corporate earnings in FY27. FY26, in any case, we are building 12% sort of an earnings. So 10% should be par the course, given that nominal GDP is growing at 10%, 11%.
Okay.
So those levels are clearly doable in FY27, 1.5 years down the line.
1.5 years down the line, we will be hitting those erstwhile highs. Nishilji, what about you? What's the best case scenario for expectation, or what kind of returns can we expect on the markets for FY26? We've begun with all this uncertainty. How do you expect the year to pan out?
I think first half anyway, we were saying basically there is going to be a challenge. So I think that challenge just deepens with this tariff issue. Second half, there is going to be a general recovery because of whatever the measures the government has taken. So I think that I continue with that stance. I don't see any challenge there. So second half is where you're going to see. I think current year should be happy basically with a 8-10% kind of a return. And I agree with Manish basically. I think next year only you will see a new high.
Next year only we'll see a new high. All right. Thank you so much then, Mr. Manish Santalia, Director, CIO, MK Investment Managers, for being with us on this special broadcast. Also, Mr. Nishil Maheshwari, market expert, joining in with all your important insights, your valuable views on the markets, and of course the impact of Trump's tariffs. It's been an important day and will continue to be for all of us to really look at the fine print. Hope you have a great day. Till the time we see you next very soon on another edition of Business Today Television. Thank you to both of you.
Thank you.
All right, viewers, we'll wrap up the morning edition. First 45 minutes are out on the markets. We are not too bad. 23,200 is back with us, 96 points lower on the Nifty. 4.4% of course is a cut at this point in time. The Nifty Bank is better off than the Nifty with just about slight 0.1% lower, 51,286 at this point in time. When we look at the sectors, it's only pharma that's up by about 3.2%. Rest all of the sectors are still reeling under pressure, with IT the worst hit today after Trump tariffs announcements. 3.3% lower for the IT index. Autos down by 1.2%. Metals down by over 1%. Oil and gas also sliding in. So there is a lot of volatility that's taking place. Top movers on the Nifty are Sun Pharma, Cipla, Dr. Reddy's, Titan, Power Grid. Then when we look at the top laggards, you have IT names. TCS down 3%. HCL Tech down 3%. Tech Mahindra, Infosys. You also have auto names like Tata Motors and Bajaj Auto down by over 2% each at this point in time. Throughout the course of the session, viewers, and the day, we will be getting you top market voices to analyze what has gone in over the night as far as tariff announcements are concerned. We'll keep on bringing some important aspects in various chunks, so stay tuned. It's an important day of trade. You don't want to miss all the action on Business Today Television. Hello and welcome. You're watching